Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a good day. I've got a real simple one for you, but I'm going to geek out a little bit if you don't mind. If you're a regular viewer of this channel, then you know I usually say you go into your 401k up to the match, meaning you contribute up to the match, whatever they offer, 3, 4, 5, 6% or more, hopefully. And then from there, you move on to the Roth IRA. And I get the question every now and then, what is the deal? Why are you saying that, man? Help me out. Let me understand that. Well, we've never actually done a video to break it down into these numbers. So I'm going to try to do that for you here today. So let's do it. So let's say you have a 401k at work, all right? And they match 6%, right? I'm going to have to use a salary of some amount. I'll use $50,000, all right? So you make 50 grand in a year, and you've got a 401k. And they match 6%, right? Good for you. They got a nice match in there. So you're going to put in 6% of your salary, and the company's going to match 6%, right? So let's say that that's what you're doing. $50,000, you've got $3,000 of your own money going in and $3,000 of the company match going in. Can you read that? Yeah, looks good. Okay, so from there you stop. That's it. You don't do any more, right? You've got $6,000 going into a 401k, all pre-tax money. The next thing you want to do is move over to a Roth IRA, and you're going to put in, hopefully you can put in the $6,000. In this example, I'm just going to assume that you put in the $6,000 because it makes the math easy for me. It's been a long day. So this is a current plan, assuming you have to save that much. One of the things we do for all of our customers is we go through and figure out how much do you actually need to save. If you don't have to save that much, don't bother, right? Only save what you need to for retirement and then stop, right? So in this example, we're assuming the person has to save the 6% in their 401k, total of $6,000 with the match, and the $6,000 over there, giving them $12,000 in a year that they're saving, right? What happens if you just say, forget it, I don't want to have two accounts, I'm going to do 6%, or I'm going to do 12%, get my 6% match, and I'll get the same $12,000, right? Or I'm just going to get a total of $12,000 into it. You'd actually have to do more, but you get what I'm saying. So if you did that, now all of that money becomes taxable, assuming it's in a regular 401k. So let's go through this. If, let's say, for example, the money grew to $1 million, right? Let's just say it's $1 million, whether you used both accounts or you just used the one account. Here's what happens. You get to retirement and you go, that was pretty sweet living on $50,000 a year. I think I'd like to live on that when I retire. Inflation adjusted, of course. But let's say you go, all right, I need $50,000. I'm going to retire, but I don't want my salary to stop. Well, if you have a 401k, you start pulling money out. It's all pre-tax. So let's go over how that would work. As of now, as of the current tax laws, and I'm going to just round up to make this simple. Let's say you take $20,000 out. That's going to be taxed at 12%. Right? And then you've got $30,000 left to take out. The IRS is going to say, all right, you owe us 22% on that. That's the current tax laws right there. So what you end up with is $2,400 in taxes, and then $6,600 in taxes for a total of $9,000 you're going to owe in taxes, assuming tax laws stay the same. I mean, I can't guesstimate what's going to happen there. So you got $9 grand if you only use the 401k, all pre-tax money. Let's do it differently here. We're going to use the same $50,000, so you don't have to go through all this again, right? But now let's say you go, well, I did the Roth too. So I did my money in the 401k, I did my money in the Roth. You need to take out $50,000. There's a number of ways you can do this. This is by no means the most efficient way, but let's go, you're going to have $25,000 coming out of the 401k, just to give you an example. Of course, it's probably a better way to go about this. So let's say you divide it evenly, your earnings. You pull out $25,000 from the 401k. What happens? 20 of it is going to get taxed at the 12%. So you got 20, let's just do at 12%. So it's the same thing. You're going to have the $2,400, right? And now you've only got $5,000 left over, which spills into the next tax bracket. I get it that it's not exactly $20,000. It's close. It's like a couple $100 off. Just using it as an example. You've got $5,000 at the 22% as of the current tax laws there, and that would make $1,100, right? So you've got a total tax bill there of $3,500 from the 401k. You had $9,000 a minute ago. So you got $3,500 is your sort of tax rate. I get it, deductions and all that stuff, but on the surface, raw numbers, $3,500. Then you go to your Roth and you say, hey, I'm going to take $25,000 out of that thing. Well, you're retired now. You owe zero in taxes. So your total tax bill now, $3,500 raw on the surface sort of number versus the $9,000 that you were going to have to pay if all you did is put your money in the 401k. One of the saddest things for me, I come across so many people every day, is that when they weren't taught how to sort of be efficient tax-wise, and they have all their money in a pre-tax 401k, they go to retire and I go, okay, we really have to sort of strategize here because you don't have that flexibility of the Roth. So bottom line is, when you set this up, if you're a beginner, you're just getting started, or you're going along the way here, you put the money into the 401k up to the match, then you use the Roth IRA, or if the Roth 401k is an option, that's good too. But that's why you want to do it. We're essentially, we're shaving almost 2/3 of your tax bill by doing that, and all you had to do was have a separate account with your 401k, make the money go one way, make the money go in the other way, mind your investments, make sure they're invested correctly. You want the money to grow uniformly if you can do that. And that's how you do it. So that's sort of the number way of explaining it. Of course, we offer Roth IRAs here. We help with the 401ks. Part of our service is to help with all of your accounts. So we may manage your Roth IRA for you, IRA, rollovers, whatever it may be, but that doesn't mean I don't want to look at your other accounts. I want to help with the 401k. I want to make sure your net worth grows along to your plan, right? And so like I said, that's the second thing we do. We're going to figure out how much money you actually have to put away, and maybe you don't even have to try as hard. If you're younger, you probably got to save a whole lot less for your goal. So that's it. That's all I wanted to share with you. Very basic. I know some of you are probably like, oh, that was no big deal. But some people need that. We need that sort of detailed explanation versus the general advice to say, oh, just save as much as you can, make sure some goes here and some goes there. Today, we answered the why. Why are you doing that? And that's just a rough example of why you would do it that way. Hey, I hope you'll join us at 5 o'clock today on YouTube. We're actually doing a live show. It's also live on Roku and the Investors News channel if you want to follow along there. We do our live stock market update. We call it the closing beat, and we're playing a game in that show, by the way. See who can guess the Dow. We'll send you $100. But we do that live at 5 o'clock no matter where you're watching every single market day. I hope you'll stick around for that, and we'll see you then.